Welcome to the Commercial Real Estate Show, your source for insightful analysis and enlightening discussions. Hello, I'm Michael Bull, your host. Thanks for joining us on one of the 42 radio stations, YouTube, iTunes, or the show website, creshow.com. Well, today we have a very interesting show for you. We're going to talk about the U.S. office market. You know, the office market has been very interesting. There's been a lot of changes going on with the way companies are using space. They seem to be wanting to continue to use less square footage per employee to kind of control costs. But at the same time, we're seeing companies a little more concerned with the retention and with recruiting as the job market has improved. We've also seen kind of a change of use where companies are wanting more creative space and wanting to be in the right locations for recruiting and for transit. We've also had incredible amount of investor interest in the office market, so that has compressed rates. We've had cap rates. We've also had a great interest in investors in all types of office properties. We've had some users buying properties, so we have a lot to talk about. We're going to talk about some strategies for tenants, for investors, and for landlords. So let's get going. Please welcome my first guest. It's Ryan Severino with REIS. He's the Senior Economist there. Ryan, thanks for joining us.
Hello, Michael. Always a pleasure to be talking to you.
Well, we appreciate it. And Ryan, you guys at REIS do a great job of tracking all the commercial real estate markets, especially around the U.S. So how has the office market performed so far this year?
You know, so far this year, performance has been okay. That's a technical term that we economists use. Vacancy through mid-year is at about 16.6%, which is down only about 10 basis points from the end of last year. And that's largely due to tepid demand because construction remains relatively muted. On the rent side, things are slightly more optimistic than what's going on with vacancy. Asking rents grew by about 1.6% through the first 6 months of this year, and they're actually up about 3.2% over the last 12 months. So while vacancy hasn't budged all that much, rents are actually growing at a relatively healthy pace, though not something that I would describe at a breakneck pace.
And are these rents, as the trend on these rental increases seem to be increasing at this point?
Absolutely, and I would say it's been a slow, steady slog for the office market recovery, but the one thing that we have seen is not just increasing rate of rent growth over time, but it's been consistent in the sense that we haven't seen rent growth faltering at all. So it's been consistent and slowly improving. Okay.
And what about the differences you see, Ryan, between, say, A and B and C, and then also CBD and suburban?
You know, generally speaking, I'd say that A has outperformed BC properties. A's have had roughly the double the rate of vacancy compression that we've seen with BC from peak vacancy to where we are today, and rents have certainly been growing faster. While, as I mentioned, there is little demand out there, it is certainly focusing on A properties, while rents are relatively attractive to a lot of tenants. As far as the CBD versus the suburban story, the story there is a little more nuanced. Vacancy is definitely falling faster in the CBDs, but that's largely because inventory is about twice as large in the suburbs as we find in the CBDs. But on an absolute basis, we're still seeing more space being absorbed in the suburbs. So they're far from dead, contrary to conventional wisdom. I feel like my mission on this planet, in addition to being a good father and good spouse, is to disabuse a lot of the myths that are out there about commercial real estate that a lot of people believe. And this is one of my favorites, that the suburbs are dead. The suburbs are definitely not dead. They just, some areas are struggling and some areas are doing well. So it's really a question of have and have not suburban markets right now.
Yeah, that's a good point. And let's talk about some of those markets that are doing better or doing worse. So what are some of the cities and markets that you see that have been performing really well this year?
You know, it's still really the technology industry's world, and we're all just kind of living in it. The tech markets really continue to lead the way. Vacancy has been coming down rapidly in these markets, while rent growth has been the strongest in the nation. Even the once mighty energy markets have faltered a little bit with the serious decline in oil prices that we've seen over the last year or so, but tech really keeps chugging along. So places like San Francisco, San Jose, Seattle, Boston all show up at the top of the ranking table just because technology is such a huge growth engine for the economy right now, and it's one of the few industries that are consistently generating significant demand for office space.
Okay, and so if you were a betting man, where would you bet that the most demand will be, moving forward, say into next year? Which of some markets that you think will continue to be hot?
There, in a similar vein, the tech market should continue to perform well. I don't really see anything on the short-term horizon that makes me think they're going to get derailed anytime soon. But in addition to those, places like Dallas really shows up on the radar screen. Dallas continues to do a good job attracting companies from other parts of the country, and it's performed really well over the last year or so. Also kind of under the radar a little bit has been Miami, which has had a resurgence. As the unofficial capital of Latin American business, there's been relatively strong interest in space in Miami. Plus, the residential real estate market in Miami has really recovered nicely, and that's a big business down in Miami. So those are probably two of the ones that show up outside the usual suspects of tech New York, Houston, places like that.
Okay. So overall, are you bullish on the market moving forward, the office market around the U.S.?
I would say so. I think we should see better performance in the economy and labor market over the next, 4 to 5 years than we've seen over the previous 4 to 5 years. And when it comes to the office market, this isn't rocket science. It's not quantum mechanics or anything. Really, we just need to see office using employment, which generates demand for space. And up until, maybe the last 12 months or so, we've seen a really muted response from office using employment as the economy's recovered. But that started to change about 12 to 18 months ago, and now that we're seeing more jobs that are being created are actually sort of higher value-add service sector jobs that utilize office space, it definitely portends better times ahead for office, not just this year, which we expect to be better in the latter half of the year, but over the next, as I mentioned, 3, 4, 5 years or so. Okay.
We're talking with Ryan Severino with REIS about the office market. So, Ryan, you have improving rents, you have improving occupancy. You've also said that new supply is still very muted. So what is this doing to cap rates in the office environment?
Generally speaking, cap rates are still on a downward trend overall. I wouldn't say we're seeing quite the same pace of cap rate compression that we saw a few years ago, but this is still one of the major commercial asset classes, and it always shows up on investors' radar screens, especially institutional investors. So where we've seen strong activity have been, kind of the places that you would mention. Class A cap rates have definitely compressed further than BC, which makes sense given the stronger market environment that we've seen for Class A fundamentals over the last few years. On the market side, we really continue to see the lowest cap rates in the hottest markets, places like New York, D.C., Northern California, some of those tech markets, because investors remain so focused on markets that they really like, where the investment thesis is not necessarily a layup, but it's very well understood. So they've relatively shied away from some of the other markets out there, and there can be some sizable differences in cap rates between what I would term the have and have not office markets in the U.S. right now.
Can you share with us some sample cap rate ranges that you're seeing in some of these markets?
Boy, it's crazy. If you're talking about the really hot markets like New York, San Francisco, D.C., places like that, some deals are going off kind of low single-digit cap rates, 3, 4, 5% in some instances. And then you get to some of the have-not markets. I won't name any of them, so it doesn't sound like I'm picking on them. But in some of those markets, you're still seeing very high single-digit cap rates, 8, 9%. And in some instances, some deals that are actually trading are going off at low double-digit cap rates. So there's a fairly significant spread between what's going on in the low cap rate markets for really good deals and some of the higher cap rate markets where the deals are, they're a little marginal. Like I mentioned, the thesis isn't abundantly obvious, and a lot of investors are not tremendously excited to jump into those markets just yet.
Right. And one of the things you said, Ryan, that's impacting this market and these cap rates and these rising rates is the impact of kind of low levels of new supply in most markets. So where are we on new supply levels, and how does it compare historically to what you've seen?
Boy, there's not much of anything really going on. It's not that supply is zero, but it's at such low levels that when I look at supply over time, I will concede that it's slowly increasing, but it only really seems like an increase because the levels are so low. If we were in a more normal development environment, something that was occurring in the 90s or the 2000s, the growth in construction activity that we've observed recently would look like a glorified rounding error. I will say this, that over the last 12 months, we've seen a bit of an uptick. And again, it's from a relatively low basis, but we've seen a bit of an uptick in speculative development. And it's been selective, but I look at that as a good harbinger of things to come, because you wouldn't see investors and developers taking a flyer on space if they didn't think fortunes were improving, even if it becomes a game of glorified musical chairs at some point where they're just trying to lure tenants from older space into newer space, which I think will probably happen initially with some of these speculative developments. It's still generally a heartening sign, because somebody wouldn't be going through the motions of that if they thought, well, this will just be glorified musical chairs for 3 or 4 years and we're just going to tough it out.
Ryan, thanks for joining us, sir. Stay tuned. We'll have more on the office market. This is the Commercial Real Estate Show. The Commercial Real Estate Show is brought to you by Bull Realty Commercial Advisors, a great place to do business. Visit bullrealty.com. RealNex, a comprehensive and powerful suite of commercial real estate tools at an incredibly low price. Visit realnex.com. That's REALNEX. Xceligent, the resource professionals use for commercial real estate information. Visit xceligent.com. That's XCELIGENT. Commercial Search, the source to market and source available properties for sale or lease. Visit commercialsearch.com. For more information on these great companies, or for additional videos, podcasts, or articles, visit CREshow.com.